as I said, thank you very much, Fernando, and welcome everyone to this webinar. I will start by giving you a short introduction of the contents that we will address in this presentation today. First, I will give you a little bit of background on the project and the scope of the study. Then I will explain what we mean by mature renewables and what has been the evolution of those technologies in recent years in Europe. Then in sections 3 and 4 we will look at what are the main conditions that need to be in place so that economic support can be phased out, and what are the drivers and the barriers that enable or prevent that from happening. In section 5, we will discuss the options that we have from a policy perspective to speed up that process. And finally, we will discuss conclusions. So a little bit of background on this study. This study was carried out in the context of a European project called Towards 2030, Dialogue on a RES Policy Framework for 2030. This is co-founded by the Intelligent Energy Europe program of the European Union. And the objective of the study is to look at how renewable policy will look like in the period 2020 to 2030. And we look at renewable policy from different angles. For instance, what are the challenges that the renewable policy will face and how those challenges can be addressed by good policy design. We look at what are the effects of different target setting options at European level and national level also. As you know, Europe, as most of you probably know, Europe has set 27% target for renewables in the year 2030. So we look at the effects of different options to set those targets at the European and national level. Then we look also at different electricity market design, which will be critical for the development of renewables in the future. And also at what are external developments outside of the EU that can affect European policy, European renewable policy. In the bottom part of the slide, you see the partners that participate in this project. This led by the Vienna University of Technology. Together with Ecofis, there's other research institutes and universities participating across Europe. If you're interested in these projects, you can visit the website that you have on the top left of the slide, but you can also directly contact me and I will be happy to discuss. So one of the tasks of this project is to analyze the policy challenges in the period 2020 to 2030. And one of those challenges or open questions is whether it will be possible to phase out support to renewables in this period. So with the purpose to address that question, we carried out the study that I'm presenting today. Again, if you're interested in it, you can visit the website that is in the slide, but you can also contact me directly. The objective of the study was not so much to understand exactly when phase-out will happen, but rather to understand what are the dynamics behind it. So what are the conditions, the factors that enable the phase-out to happen. And in particular, because we are talking about Europe without endangering the actual targets that have been already set for the year 2030, because of course renewable support could be phased out anyway, but that would have an impact probably in the deployment right after that. In terms of the scope, we looked at the technologies that are most deployed and therefore most mature. We understand that these technologies are solar PV and wind and shore, and we will show why later. We analyzed the competitiveness of these technologies in the wholesale markets. So mostly we are looking at utility scale projects. And It is true that the PV in particular is also becoming very competitive in the distributed generation field, but the factors of competitiveness and dynamics and the policies to address those are very different from the wholesale markets. So for this reason, it's not part of the scope of this study, although it's something that we at Ecofis are working on for sure in multiple projects. In terms of the geographical scope, we are focused on the European Union due to the nature of the project. However, many of the elements that I will discuss are applicable to other jurisdictions. So what do we mean by mature renewables? In this graph, you see the evolution of low carbon generation technologies in Europe since 1990 until 2014. As you see, hydro and nuclear remain fairly constant. Hydro increased a little bit. Also, pumped hydro increased a little bit, and biomass. But the two technologies that stand out as the major growers over this period are wind and solar PV. In the case of wind, already by the year 2000, there were 10 gigawatts installed. Now the capacity installed is more than 130 gigawatts. And most of it is wind onshore. The participation of wind offshore is about 11 gigawatts as of today. Then the development of solar happened later, but it caught up quite quickly with the speed of growth of wind. Today, there's 95 gigawatts installed of solar PV in Europe. So I think from this graph we can agree that wind onshore and solar PV are the two main renewable actors in the market today, and will probably be the main actors also in the period 2020 to 2030. Now, the growth in deployment that we just saw was accompanied by substantial reduction in costs, both for the PV technology and wind technology. On the left side, you have the evolution of PV module prices since 2009 until November 2014. The cost started at a range of 2.5 to 4 US dollars per watt peak, and by November 2014 they were well below 1 US dollar per watt peak. And the situation now is the prices are even lower than that. And for wind turbines on the right side, after some period of stable or even slightly increasing prices for wind turbines, after 2009, those prices have again gone down. And now most of the deals that are done with wind turbines for 2016, 2017 are well below 900 euros per kilowatt. So again, also for wind, strong cost reductions accompanying deployment. Despite these cost reductions, and because deployment has been strong over the last 15 years, also the costs of supporting these technologies have been piling up. And you see there, those are the figures, the latest figures that we have. So in the year 2012, the total cost of supporting wind onshore in Europe was approximately 10 billion per year across the EU, and the cost of support for PV was 14 billion per year. Now the question is, this is normal, so technologies are in an early stage of deployment require support, and that support will increase due to the increased volumes in the market. But the question is, when this level of support will peak and start to decline until it can be finally completely phased out. So that's the question that we are asking. When can economic support be phased out, or in other words, what needs to happen so that economic support can be phased out? typically, the way we look at this is summarized in this slide. We see that there's a fact that technology costs are going down, and because of that, the generation costs for renewables are becoming competitive with conventional technologies in some cases. And when that is the case, the question is why we should keep economic support. It's time to phase out economic. Now, we believe that there's two gaps in this logic. The first gap is that technology costs are only one component of the levelized cost of electricity for renewables. There's more to that. There's operation and maintenance costs, obviously. There's development costs that can vary a lot depending on the conditions. But most importantly, there's cost of capital. The generation costs are very sensitive to the cost of capital. So that's one gap in this logic. And the second gap is that even in the case that the renewables become competitive with conventional technologies, that doesn't mean that revenues will be sufficient to cover the generation costs. Actually, the case now in Europe is that these revenues are not sufficient to cover the generation costs. So let's take a closer look at what is the structure of costs for renewable projects. We see first we have investment costs, which is basically paying back the initial investment to develop or build a plant. And then we have the cost of capital that usually doesn't get so much attention, but is a critical element of the generation costs. The cost of capital, as a rule of thumb, for instance, let's work with an example. A PV project, if we finance that project at 3 or 4%, the weight of the cost of capital in the overall generation cost will be around 25–30% of the overall generation costs. If we don't find such good finance and we go to something like 8 or 9%, then the weight of the cost of capital goes to 50% of the overall generation costs. So again, the sensitivity of generation costs to the small variations in the cost of capital is very important and is one of the key elements to phase out support in the future. And then we have the operation and maintenance costs that typically are the smaller fraction that they cannot be neglected because they can be substantial in some cases. Now, on the other hand, we have the revenues. And as it is the situation now in Europe, these revenues are not sufficient to cover the costs. Again, let's work with example figures. We could think of developing a wind project in Europe for about 60 euros per megawatt hour, 70 euros per megawatt hour, around that range if we are optimistic. If we are talking about PV, for instance, the latest auction in the German market was awarded at around 72 euros per megawatt hour. Now, when we look at the revenues, the average wholesale market price in Europe today are well below 50 euros per megawatt hour. So there's a gap to be filled with economic support still. So this is the first condition, that revenues cover the cost. And it's an obvious one, but it's one condition that is not yet met in Europe despite the reductions in technology costs. The second condition is that the level of risk that is associated to the investment has to be acceptable for investors. That means if there's a risk in the market because there's uncertainty about the future revenues, and that's what happens when we phase out support, because support schemes provide a certain protection to that risk. If that risk goes up, then the reward also has to go up, so the revenues have to go up. And conversely, if we manage to lower the level of risk in the project, there will be more interested investors and financial institutions ready to put the money in renewable projects. So these are the two main conditions that need to be in place to phase out support for renewables. Now, with these two conditions in mind, we have identified and analyzed drivers that contribute to reduce generation costs or to improve revenues, and barriers that work in the opposite direction. So starting from the generation cost side, let's take a look at drivers. We already mentioned before, technology cost reductions. These have been substantial in the past, and there are good reasons to think that they will continue in the future. For instance, a recent report by IRENA estimated that by 2025, the cost for PV could go down as much as 57% compared to 2015 values, and in the case for wind, that could be 12%. So still, technology cost reductions will keep being a strong driver for generation cost reduction. Then another element is the stability of policies. Even in the absence of support, renewable policy, economic support, renewable policy can contribute to reduce generation costs. And this can be done by providing stability, by providing credible targets, predictable regulatory frameworks. If there's a stability in the policy, then that gives a positive signal to investors. And even if support is progressively reduced, also generation costs can also be reduced due to the reduced perception of risk. And then if we enter this positive cycle, when there's steady policies, there's steady development, and markets mature. And mature markets are characterized by a large number of actors, and therefore increased competition and lower costs for developers. That's on the private sector, but also public institutions that acquire experience can also help project developers by facilitating administrative procedures or grid connection procedures that also reduce the cost. And also financial institutions, when they are experienced, they can also provide more specific solutions for renewable projects to mitigate project risk. And then finally, another driver for cost reduction will be the general conditions of financing, the macroeconomic conditions of the country in which the project will be developed and the availability of cheap finance in that particular country. Then, what is keeping generation costs up? One of the barriers that we see for reducing the generation costs is what we call here market entry costs. By market entry costs, we mean everything that the project developer needs to do before being able to sell electricity in the power markets. This means the administrative procedure and the cost of grid connection. And these not only go directly to the investment costs, but they also, if they are uncertain, they also affect the cost of capital. If we don't know at which point we will get a grid connection, that if we go with that uncertainty to the bank, it's difficult to convince that they give us cheap finance. Then another barrier is the market integration cost, and this is due to the intrinsic nature of variable renewables like solar and PV. Because the output of these plants is uncertain to a certain degree before the delivery, the physical delivery of the energy, there's a difference between the forecasted electricity and the actual electricity that was delivered to the market. And that deviation, that forecast error needs to be balanced by someone. When renewables operate under a support scheme, this cost is sometimes mitigated. There are some support schemes that expose project developers to this risk. But when support is phased out, then this risk is there, and this cost will be there. Now, we are not advocating here that renewables should not be exposed to this risk, but there's a big difference in how, when regulations are well done and when regulations are not well done, these market integration costs can be higher or lower. And finally, another barrier or another element that keeps generation costs high in the case of phasing out support is the risk in future revenues, because risk in future revenues increases the cost of capital. The revenue risk comes in two flavors, so to say. There's price risk and there's volume risk. When renewables operate under a support scheme, they are protected from price risk to different degrees. If they operate under a feed-in tariff, the price is guaranteed almost completely, whereas if they operate on a feed-in premium, they are already exposed to certain market variations, and this exposure is higher with green certificates because they are exposed not only to the variation of the power prices, but also to the variation of the green certificate. Still, they are, to a certain degree, protected from price risk. When support schemes are phased out, then this revenue risk is likely to increase for project developers. That's on the price side. And then on the volume side, in systems with a larger penetration of renewables, there's increased risk of curtailment of renewable plants in order to manage congestion in the grid. And that also increases revenue risk and therefore cost of capital and the generation cost. Now, moving on to the revenue side, what are the drivers for increased revenues for renewables? In the recent past, one of the main arguments to invest in renewables was that fossil fuel prices were set to increase in the long term. Now, this trend is no longer so clear. However, that does not mean that fossil fuel prices do not play a role. They are still playing a role because they directly influence the marginal generation costs of fossil fuel generation plants. So if fossil fuel prices go up, that means that the wholesale market price will go up, and that means that the potential revenues for renewables will go up. The similar logic applies to the price of externalities, or the carbon price in this case. In Europe, there's one instrument to internalize externalities, which is the emissions trading system. Unfortunately, the carbon price today is very low. But if this price would increase in the future, that would create upward pressure in the wholesale market prices by increasing the operation costs for fossil fuel plants, and that would again increase potential revenues for renewable plants. And finally, another additional source of revenues for renewables could be the provision of balancing services. So renewables could provide downward balancing, and they are also technically capable of providing voltage and frequency control or other ancillary services. That could be another additional source of revenue for renewables in the future if the regulatory frameworks allow for it. Now moving to the barriers that are limiting further revenues for renewables. The first one is what we call, and has been called also in literature, renewables cannibalism. This is an effect by which renewable plants undermine their own revenues by participating in the market. I will try to explain this further with a graph. We see here the situation of a generic market, a generic situation of a generic power market. And you see, for instance, in this case, we have 55 gigawatts of demand. In the horizontal axis, you have the capacity that different technologies are offering to the market in that precise moment. And in the vertical axis, you have the prices at which these capacities are being offered. So starting from the left to the right, we start supplying this demand, and then the market price is set at the price of the marginal generation price or generation cost of the combined cycle gas turbines. Now let's imagine that the sun starts shining or the wind starts blowing, and we have additional supply of low marginal cost renewables. Solar and wind are low marginal cost renewables because they do not use fuel, so they can offer their electricity at almost zero price in the market. The result of the entry of this additional 15 gigawatts of wind and PV is that the supply curve moves to the right side. And now the price is being set by a cheaper technology, which is coal. So what happens here is sunny and windy periods in systems with high penetration of solar and PV tend to be periods of low market prices. But because solar PV and wind can only operate in those sunny and windy periods, they end up getting those low prices that they themselves contribute to generate. So that's why they, in a way, cannibalize their own revenues. You can see the effect of this in the graph below. On the left-hand side, you have the effect for wind, and on the right-hand side, you have the effect for solar. Roughly for large penetrations of wind in the order of 30%, the revenues can go down by 30%, 25%, 30%, 40% of the with respect to the average wholesale market price. And in the case of solar, you get those reductions with lower penetrations in the order of 15%. So this is a challenge for renewables because, as we saw before, the revenues from the market are not sufficient, but also they undermine their own revenues from the market. This challenge would not be so problematic if we had flexible systems that would react quickly to that additional supply of cheap renewables. If there would be a quick response from the demand side, either storing electricity or using additional electricity, then the price would be equilibrated and the effect of that additional electricity in the price would not be so strong. But that is not the case yet. The power systems of today are still limited in terms of flexibility. So that's a barrier that fits the previous barrier, and the two work together and enhance the effect of the other. And finally, another barrier is subsidies to conventional generation. Well, actually in Europe we still have subsidies to conventional generation. It's important to note. And those subsidies artificially reduce the generation costs for fossil fuel plants and therefore undermine the potential revenues for other market actors. So these are the main drivers and barriers of competitiveness of renewables according to our view in the wholesale market. Now we will look at the options that we have on the policy side to enhance the effect of the drivers and to mitigate the effect of the barriers. So starting from the generation cost side, one thing that governments can definitely do is to adopt the best practices possible in terms of administrative procedure and grid connection practices. The latest report from the European Commission noted that there has been a lot of progress indeed, but there's still a lot to be done. And indeed, there are large differences in the costs, administrative costs, and also in grid connection costs across Europe. For instance, with grid connection, the average grid connection cost in Europe is around 5% of the total generation costs. However, in some European member states, this reaches 15%. Then another thing that can be done is to adapt the design of the market to the intrinsic nature of renewables, the intrinsic variable nature of renewables. The three measures that you see in there are aiming to reduce the market integration cost that we were discussing before. Intraday markets allow renewables to mitigate the effect of the imbalances by trading those imbalances during the day. And high-resolution bids, so meaning trading instead of in hours, for instance, in half hours or 15 minutes, that reduces the size of the imbalance. Also, if trade is done as close as possible to real-time delivery of the electricity, that also helps to reduce the imbalance for renewables and therefore the costs of integration. Directly related to cost is risk mitigation. We touched upon this already before. And these measures have been extensively discussed in the past with regards to reducing the costs of support while support is still needed. So if we are talking about removing support for renewables, then these measures become extremely important. Starting from the top, well, we already said targets that are credible are having a positive effect on the cost of capital. the stability of the policy generally also has a positive effect in the cost of capital. But then that is with regards with the general renewable strategy of a certain member state. But then how those rules are actually operated in practice, how transparent and efficient they are, also have a direct effect in the cost of capital. So how transparent the permitting procedures and the planning procedures from different regions, that affects the risk for a project. How transparent the market operations rules are, and also with grid operation rules. For instance, if we don't know upfront before investing what will be the rules for curtailment in a certain system, we have a lot of uncertainty about our future revenues. And then finally, the renewable policy can help renewables without support by underwriting part of the risk that is involved in a renewable project. For instance, through guarantees, stepping only in the case that the project defaults. And then moving finally to the measures to improve market revenues. We already touched upon this before, so this is the other side of the coin of the drivers and barriers that we discussed before. A sufficient carbon price signal. Carbon prices have been below 10 euros per ton for many years. If we look at literature, the actual value of the externalities in the order of 50 euros per ton. So any carbon prices will be above what we have now would be positive for the business case of renewables. Then market design that enables the participation of the demand side in order to increase the flexibility of the system. That's also key in order to keep the revenues high for renewables in the future. Removing subsidies to conventional generation. And then finally, something that I didn't mention before. One of the reasons why the market prices are so low is because there's excess capacity in many European markets. So that's an opportunity to phase out the most polluting and less efficient plants. So to conclude, indeed, generation costs for renewables are increasingly competitive with those of conventional plants. And this means that there needs to be a change in focus in renewable policy. In the past, renewable policy has been about providing direct support to to make renewables become mature. Now, this focus has to shift into creating an environment that enables the investment. That means the right market rules and the right investment conditions. However, the conditions to phase out support for renewables in the EU are not there yet. We saw before that the revenues, as of today, do not cover the generation cost in most cases. So that means that economic support will be needed still for a transitional period. And the length of that period will be until markets deliver sufficient and sufficiently predictable revenues to cover generation costs. The good news, however, is that the amount of economic support can be minimized by playing with the drivers and barriers that we discussed in this presentation through policies that address those barriers and drivers. And with this, I would thank you, and either my colleague, Corina Klesman, or myself will be very happy to answer your questions if you send us an email. And I will stay now online to answer your questions.